Before we begin, a brief note. The following content is strictly for educational purposes and is not financial advice. You are at your desk executing a well-planned trading session. You identify a rule-based technical setup, calculate your risk parameters, and enter the market with discipline. The market abruptly reverses. Price spikes through your support level, triggering your stop loss and realizing an immediate financial reduction to your account. Within seconds, a sudden visceral tension completely takes over. Your hand hovers over the mouse and your fingers twitch. You are experiencing the overwhelming urge to recover that lost capital immediately. It is tempting to believe you have spotted a new market edge. However, a rational evaluation of the current price action reveals no valid opportunity. A revenge trade is a subconscious psychological hijacking. It functions as an urgent attempt to restore your internal emotional balance. When we analyze a clinical cross-section of a human brain at the moment of a financial loss, one observes the amygdala, the brain's threat response center, immediately light up and expand. Human biology equates a sudden financial loss with physical pain or a direct threat to survival. The brain routes energy away from the prefrontal cortex, the logic center, directly towards this reactive threat center. This energy shift creates a closed feedback loop. The intense compulsion to execute a new trade is the brain attempting to erase the psychological pain of being wrong. Experiencing this powerful biological reaction is a normal human response to acute stress. It does not indicate that a trader is inherently weak or lacks discipline. This sharp instinct to dive back into the market is an ancient biological survival reflex operating in disguise. Back at the trading desk, this internal demand for emotional repair translates directly into rapid, impulsive physical actions. Established rules are discarded. The trader stops looking for statistical probabilities and begins hunting for a quick win to soothe the immediate sting. This chart shows how the urge to recover capital compromises position sizing risk. The stable bar represents a sound allocation, while the volatile bar shows the massive, erratic risk typical of a revenge trade. Doubling down on position size while operating without logical oversight carries a high mathematical cost. A single controlled loss often transforms into a rapid, fatal account drawdown. The market is a neutral mechanism. It remains indifferent to a trader's personal need for validation or financial recovery. Deploying capital as a tool for mood regulation leads to a deeper financial hole. Relying on willpower to fight a biological survival reflex in the heat of a live market session is rarely effective. Professionalism requires a structural intervention to physically short-circuit this destructive behavioral loop. The pause rule is a non-negotiable requirement to physically stand up and step away from the trading screens immediately following an emotionally charged loss. While you cannot stop the initial wave of emotional pain from hitting, physical distance ensures you cannot cause financial damage while that wave passes. Implementing this mandatory physical separation is the true mark of professional consistency. It separates reactive gambling from calculated execution. Success depends on aggressively controlling the physical environment when the pain of a loss inevitably hits. What emotion usually appears right before your revenge trade?